Our next issue here is some of the default rules that are relevant to partnerships. In other words, these are things that under the Uniform Partnership Act will apply unless the parties agreed to differently. The default rule is that each partner has an equal ownership. So if you have three people running a business and you didn't specify otherwise, each one will own 1/3 of the business. So if you're in a partnership and you invest more, or you want to establish that you are a majority owner, you'd better say so. If you don't say so, you might be prevented from doing so later on. That's very important. Upon dissolution, when the company goes bankrupt or the company stops operating for whatever reason, it doesn't have to go bankrupt, it could be doing very well, but it dissolves for whatever reason. First, the debts get paid off, then the capital investments get paid back. In other words, each partner gets back what he or she put into the partnership, and then the leftover is split equally if it's owned equally, or if it's not owned equally because they agreed on a different structure of ownership, then it's split proportionally. If I own 50% and you own 50%, then it's 50-50. If I own 40% and two other people own 30% each, well, then I get 40% of the leftovers. Evidence of a partnership, again, usually when we're talking about trying to sue one of the partners for debts of the partnership, which is where this becomes important, there could be prima facie evidence, which means evidence on its face, clear evidence that you don't really need any interpretation for, simply receipt of the share of a business profits. If somebody gets a share of the business profits, well, it's obvious that person is a partner. Or, even without that, you can still prove the existence of a partnership by an agreement to share in the profits and losses and the right to participate in management. Even if the word partner is not used, if you can show that the parties agreed that they were going to manage it together, or that they agreed that they were going to split the profits, well, then you can use that as evidence that there is a partnership. Those are all cases in which there's not actually a partnership agreement. Where there is a partnership agreement, obviously that controls. And that's the sort of thing that could be in writing, or it could be oral. It's recommended that it's in writing, and anything can be put in there. If something is not put in there, then you would have to look to the Uniform Partnership Act to fill in any gaps that did not occur in the agreement. And the Uniform Partnership Act mandates, which means says, the right to an equal share in the profits and losses, again, unless the agreements provide otherwise. However, one little caveat is that if the agreement establishes a different profit-sharing arrangement, well, then that will be the assumption is that that will apply to losses as well, and vice versa. So normally if there are three partners, A, B, and C, well, the assumption will be that the losses are 33, 33, 33, and the profits are 33, 33, 33. But what if there's an agreement that says A has the right to 50% of the profits and B and C 25 each? Well, then the assumption will be the same thing as losses, that the losses will also be 50, 25, 25, and the same thing is true the opposite. Again, the theory being that if the division of losses or the division of profits is stated, that is the assumption in terms of how much of the partnership each person actually owns. In terms of managing the partnership, there is also the question of compensation. What if one of the partners, A, let's say, goes out and starts the business and goes out and spends a year and spends, 1,000 hours of time working on the partnership business? Is that person entitled to compensation? Well, the general answer is no, unless it is specified in the agreement. So if you're going to work on behalf of your partnership, if you and a few other people have a partnership, and you're going to work your head off trying to get the business going, well, then make sure that there's an agreement, preferably in writing, among the partners that you're entitled to reasonable compensation, that you're entitled to get something more than just your share of the profits. If you don't, the assumption will be that you're doing it out of the goodness of your heart, that you're doing it because you're a partner and you're trying to make the whole business do well, but that you're not entitled inherently to a salary. On the other hand, indemnification is automatic. So if I spend $500 on legal fees to get the articles of partnership written, or if I spend $2,000 on an agreement, if I actually lay out money on the partnership business, the assumption is that the partnership will pay me back. Then there are some other rights that are relevant to partnership. There's the right to return of loans and capital, which means if a partner lends money to the company, or if a partner contributes money to the company, the assumption is that eventually the partnership will have to pay that person back. as we just discussed. And finally, we've got the right to information. The right to information means, as it sounds, is that partners have the right to true and full information from any partner regarding anything that affects the partnership. If I want to see the partnership's tax returns, or I want to see where the partnership spent its money, if I'm a partner, I have the right to that information. If the other partner, whichever partner does know the information or does have the information, has a responsibility to provide it. And partnership books have to be kept at the partnership's principal place of business, and the partners have the right to inspect or copy the records anytime they so choose.